All right, I told Adam Lashinsky I'm working on a book on the history of the internet, and he said, well, why don't you give a presentation? Okay, well, I'll give a presentation. 20 years, 10 lessons. And why should I give this presentation? Because I've been covering internet stocks since the founding of Google and the eBay IPO. You can decide which was more important of an event, because I got a couple of awards, blah, blah, blah. It's all listed up there. Why shouldn't I give this presentation? I put a sell on Amazon in 2003, right before it began one of its major inflection points. I've had a buy selectively on Snapchat since its IPO, and I did put a buy on Blue Apron at its IPO. So caveat investor, here we go, 10 lessons. 20 years, 10 lessons. First, there will be blood. There's an enormous amount of fashion risk in this industry, no real switching costs, uncertain management teams, uncertain business models, uncertain market opportunities. Even if these companies escape through that airtight screen of the private capital markets, they get into the public markets, they can still blow up. So just expect that. It comes with the territory. Secondly, even the best stocks can suck at times. That's a technical expression for those who didn't go to get an MBA. And I don't mean the 5% correction that Netflix is going through today, which is really nothing when you think about a stock that's up 115%. I'm talking about 75% corrections. That's Amazon back in 2000, 2001, Netflix in 2011, Google in 2007 and 2008. These best-of-breed assets, the best management teams, the best companies, as stocks, they can all suck from time to time. So just be wary about that. Lesson 3. There are two ways to think about the public markets. You can play the expectations game, or you can play the fundamentals game. If you're playing for quarters, if you're trying to get that 10% pop up or down on Netflix last night, or coming up on eBay tomorrow night, you're playing a fool's game unless you happen to work at a place that pays for all the data sources, know what the money funds are, money flows are, knows what the expectations are, knows what the whispers are. Don't play that game. It's a fool's game. Don't play quarters. Instead, play fundamentals, or think about fundamentals. I mean, it's really simple. If you find a company and you believe a company can be materially bigger 3 to 5 years down the road than today, you'll probably make money on that. Okay, I really simplified 20 years of investment history in that slide. But take a look at this. This is Amazon, the stock price versus the annual revenue. These things are pretty highly correlated. Now, I know we're supposed to use DCFs, and I use them. We look at price to earnings multiples, et cetera. I don't know a single company, though, that's ever generated cash flow without first generating revenue. Unless there's something dramatically wrong. Unless there's something dramatically wrong with the revenue, the business model, generally profit pools follow revenue streams. So focus on fundamentals. Really ask yourself that action question. Is this an asset that years from now can have 30, 40%, 50% more customers that'll pay them more? Just keep focusing on those basic questions. The markets are actually really long-term in nature. I know Adam disagrees with me, but I disagree with him. I think you look at what the market, the kind of multiples that it's putting on Amazon and Netflix, people are obviously willing to go out multiple years and discount back because they believe these fundamentals can grow over time. Focus on fundamentals. Focus on fundamental inflection points. When you see Netflix, it's up over 100% or almost 100% this year. Why? Because revenue growth is accelerating. Why? Because margins are expanding. When you get that combination, it's like the earnings growth aperture is widening. Multiples can go up, earnings estimates can go up. So at the end of last year, if you had stepped back and thought, well, Netflix, they've just announced a price increase. They did it 2 years ago. They did it successfully. They're rolling out into more and more international markets. And last time I checked, they've been pretty successful at that so far. And they're rolling out more and more hits. Money Heist is a great example of that, popular in multiple countries. If you put those three things together, you only had to get 1 or 2 of them right and realize this could be a revenue growth acceleration year. Revenue growth acceleration usually begets operating margin expansion. It's a fundamental inflection point, and that's what causes stocks to gap up. So look at those. And of course, the corollary of that is when you see revenue growth sharply decelerate and margins come down, run for the hills. All right, lesson 6. Big picture, this is story time. Focus on big TAMs and low penetration. That almost sounds like soft porn. I don't mean it to do that. TAMs. TAMs, total addressable markets. Low penetration, I mean market share. And the reason I mention this, I think about this company, Google. It's amazing what they've done. For 33 straight quarters, they've grown 20%, quarter in and quarter out. That's never happened before in financial history. Never, at least not that I've been able to find, and I've tested this numerous times. So the open question for investors is they can't possibly sustain that growth rate. My God, they're $100 billion in revenue this year. But that's not the right way to think about it. That's backwards looking. Think about how big the TAM is. And this is global advertising. It's over $1 trillion market. So guess what? That $100 billion in revenue is at max 10% of the end market. So they can sustain that. Companies like Booking.com account for 5% of global travel. You bet they can sustain premium growth rates. Amazon's 2%. 2% of global retail. You bet they can sustain these growth rates for a substantial period of time. Lesson 7, scale doesn't just matter, scale wins for 4 reasons. There are these experience curves. The longer the companies operate, the processes get better, the management teams get better. There's unit economic improvements. The ability for somebody to catch up and underprice and undercost the scale leader gets smaller and smaller over time. The scale winners go to the unit economics. Third, scale equals moats. This is the exercise I ask people to think about. 5 years ago, if you'd wanted to try to replicate Netflix, you would have needed about $8 billion. $5 billion for content, $2 or $3 billion for marketing. You want to try to replicate Netflix today as they become bigger, they've got more scale, you would need $15 billion. $12 billion for content and $2 or $3 billion for marketing, or maybe a little bit more than that. So scale creates moats around these businesses. And finally, there's network effects. Probably one of the most overused expressions in tech investing. There's some value to it. I think the others are more important. But scale doesn't just matter. Scale wins. Find scale companies. Okay, I'm going to have a little fun here. Lesson 8, look for the lucky lexicons. So when companies become nouns, when they become verbs, and when they become part of the popular vernacular, that's usually a pretty good time to invest in the stock. It's not the peak, and the reason it's fundamentally not the peak is that when they become part of the popular vernacular, Netflix and chill, this was 2.5 years ago, that means that their need to advertise, their need to market is dramatically shrunk because they're already part of the vernacular. So when you find companies that have, you Google it or, check out her tweets, when you find that kind of stuff, it's usually a safer investment. Look for companies, look for the lucky lexicons. All right. Lesson 9, valuation doesn't matter. I didn't really mean that. Valuation, of course, matters, but it doesn't always matter, especially with platform companies that are chasing really large market opportunities. The P and PE can sometimes be platform, and what platform companies do is they create new revenue streams. Amazon now is going to be the 3rd largest global advertising company. Why? Because it's a platform company. It's got all these consumers there for another reason, retail. You can advertise to them. So platform companies can create new revenue streams. So when this bozo on the right downgraded Amazon back in 2003 and put a sell on it, he missed it because he didn't realize that this was a platform company that could create new revenue streams. And when this guy on the left, who wrote the definitive book on valuation and capped out Uber in 2014 at $6 billion because he perfectly valued the size, the profit pools associated with the US taxi industry, he missed it. Because it turns out that Uber became a lot more than just a replacement for taxi companies. So valuation doesn't always matter. Lesson 10, I'm going to finish with this one, then I got a bonus for you after this. 4 things to work on, 4 things to focus on when it comes to public investing. I wanted to go with 3 M's, but somebody had already taken that. So I went with 4. Market, model, moat, and management team. How big is the market? How robust is the business model? How deep are the competitive moats around the business? And how good is the management team? And of those, the one that really matters is the management team. You get really good managements, and they stay, and they're consistent. They will build new revenue streams. They'll improve the business models. They will find new market opportunities. You got one of these people speaking later today, Gillian Tans. Not the founder, but she's been at Booking.com. Really, that's what Priceline should have been called all along the years. One of the best operators you can find. And when you find people like that, you stick with them. All right, those are the 10 lessons from 20 years of investing. With less than a minute to go, I got some warning signs for you. So these are the things to avoid. Run for the hills when you see these. You ready? First, when companies buy stadium rights, that's CMGI Field. Anybody own any CMGI stock? Second, when they do those wild orthogonal acquisitions and you're wondering, like, why'd they do that? So when eBay bought Skype, it's like, well, what, the synergies are what? And what it probably tells you, and I think Alex Chasm is around here, is that they're a little concerned about growth in the core business, so we better do a Hail Mary. Third, that's not a criticism of you, by the way. That's really of Jeff Hausenbold. Third is 20 seconds, sharp growth deceleration. So Zulily goes public, great, 100% grower, but then within 4 quarters, it declines, decelerates to mid-teens. There's something going wrong. The market opportunity isn't as big as we all thought. And finally, fourth, And two of these guys have spoken here before. The CEO revolving door, 6 years, 6 CEOs, Pandora. It's a disaster for investors, so beware of those. That's it. 4 warning signs, 10 lessons. I'm Mark Mahaney. Thank you.
Thank you, Mark. How great is Mark Mahaney? Can we get another round of applause for him?